2024 has been a record-breaking year for the S&P 500, with gains over 20%. And the data I've uncovered suggests we might see even bigger returns ahead. After analyzing decades of market statistics and spending countless hours digging through historical patterns, I've found compelling evidence for what could be a massive end-of-year rally. Not only will I show you exactly why December could be the most profitable month of 2024, but I'll also reveal what the smart money is doing right now, and more importantly, what this means for your investment strategy. Let's dive in. Right now, the Fear and Greed Index shows investors are in greed territory. But here's why that's not necessarily a bad thing. Many investors make the mistake of thinking high greed levels automatically mean a crash is coming. However, history shows markets can stay hot for months, even years. What's really interesting is that we're not even in extreme greed territory yet. This actually leaves room for more upside potential. When markets eventually do cool off, it typically results in normal corrections, not the massive crashes that doom and gloom prophets keep predicting. And speaking of predictions, let's look at what the big players on Wall Street are doing right now. Let's look at what's happening between Wall Street's biggest players and everyday investors like us. Right now, we're seeing a fascinating divide in the market. While retail investors, that's regular folks like you and me, keep jumping in and out of the market based on headlines and emotions, the big institutional investors are steadily becoming more cautious. Our data shows these professional investors are gradually moving to more defensive positions. They might be seeing something that's not obvious to the rest of us yet. But here's the interesting part. Historically, when smart money gets defensive, it doesn't always mean a market crash is coming. Instead, they're often positioning themselves to buy heavily during any significant dips. Think of it like this. These big players are like professional shoppers who know a sale is coming. They're holding back some cash now, so they can go all in when prices drop, even slightly. And here's what's really important for us to understand. When these institutional investors do start buying, they typically push the market to new highs within 6 to 12 months. The key takeaway? While it's worth noting what big money is doing, trying to perfectly copy their moves isn't always the best strategy for retail investors like us. They can afford to wait and time the market. We often can't. Instead, we need to stay focused on our long-term investment plans while keeping some dry powder ready for potential opportunities. December has historically been one of the strongest months for the stock market, and the numbers backing this up are pretty incredible. Since 1928, December has almost never been the worst performing month of the year. In fact, when we look at years where the S&P 500 has gained more than 20%, like we've seen in 2024, December has been positive 90% of the time. Now, this is particularly interesting because we're currently sitting on huge gains, and history suggests this momentum tends to carry through to year-end. Compare this to traditionally volatile months like August and September, which we've already navigated through this year. But here's what makes this December even more special. We're in a presidential election year. Looking at data since 1950, December during election years has delivered positive returns over 80% of the time, with gains typically exceeding 1%. This combination of factors, a strong year-to-date performance, and the election year cycle, creates a uniquely positive setup for this December. However, remember that while these statistics are compelling, they're not guarantees. They're more like a tailwind pushing the market in a favorable direction, which is why many investors are positioning themselves to take advantage of this historically strong period. The presidential election year effect is something every investor needs to understand right now, especially as we head into 2024's big election. Here's why this matters so much. Historically, presidential election years have shown a distinct pattern in market behavior that smart investors can use to their advantage. What's really fascinating is that we're currently in what's traditionally the strongest part of the election cycle. The market typically performs exceptionally well in the year leading up to the presidential election, regardless of which party is leading in the polls. This isn't just random. It's because sitting presidents often implement policies to stimulate the economy and boost market confidence before elections. But here's the crucial part that most investors miss. The real opportunity often comes in the months right before the election. Since 1950, this period has been particularly strong, with the S&P 500 showing positive returns over 80% of the time. Think about it. That's better odds than almost any other market pattern we track. The key is to stay focused on this broader historical pattern rather than getting caught up in day-to-day political noise. Let's bust a major myth about the stock market that might be costing you serious money. You've probably heard that the S&P 500 averages 9 to 10% returns per year. Well, here's the shocking truth. The market rarely actually delivers these average returns in any given year. Instead, what typically happens is this. The market either significantly outperforms this average, like we've seen this year with over 20% gains, or it substantially underperforms. Those nice, steady 9 to 10% years, they're actually pretty rare. It's like saying the average temperature in New York is 55 degrees. You rarely experience that exact temperature. It's usually either much hotter or much colder. This is absolutely crucial to understand because it completely changes how you should think about investing. Many investors make the mistake of waiting for that perfect average year. Or worse, they pull out when returns are way above average, thinking the market must be due for a crash. But here's the reality. Those massive outperforming years, like 2024, are exactly what drives long-term wealth creation. Missing just a few of these big years can devastate your long-term returns. For example, if you had stayed out of the market this year waiting for a crash, you would have missed one of the strongest years in recent history. This is why timing the market based on averages is so dangerous. The key to building wealth isn't about finding average years. It's about being positioned to capture these exceptional years when they come along. And here's the most important part. These strong years often cluster together, just like we've seen recently. So when people ask me if it's too late to invest after a strong year, I remind them that history shows some of the best returns often come right after other strong years. Based on everything we've covered, here's the strategy that makes the most sense right now. First, don't let the strong gains we've seen this year scare you away. The data clearly shows that strong markets often continue their momentum, especially during December of election years. Second, keep some cash ready for potential dips. But don't wait for a massive crash that might never come. Remember, being completely out of the market is usually riskier than being in it, especially during historically strong periods like we're in now. Finally, focus on quality investments that have proven themselves during this year's rally. This isn't the time to chase speculative stocks. Stick with solid companies that are showing real growth and profitability. Speaking of cash positions and market timing, I have to share something fascinating with you. While we're seeing these incredible market gains, Warren Buffett, probably the greatest investor of all time, is sitting on a mind-blowing $325 billion in cash right now. He's even selling some of his Apple shares, which is completely unusual for him. If you want to understand why Buffett might be preparing for a potential market downturn, and what this means for your investment strategy, check out my previous video right here. I break down exactly what Buffett is doing with his massive cash pile and why it might be one of the most important market signals we've seen in years. You definitely don't want to miss this one. It could be crucial for protecting your portfolio in the months ahead.